Silver is shattering all historical records in recent days. Silver, trading around $60, is truly shocking the markets. But what primarily caught my attention is this. While this was happening, JPMorgan is reportedly moving approximately 169 million ounces of silver into their vaults. Industry sources suggest this represents roughly 9% of the global supply. They have been quietly accumulating since 2011, that is, for 14 years. I keep asking myself, if silver is worthless, as many experts claim, why would America's most powerful bank be hoarding this metal? My theory is simple. Something very significant is unfolding. And I want to show you a formula that has appeared in every major financial crisis in history, a formula that has never failed. Right now, in my analysis, we might be watching this formula complete in real time. Do you still have a chance? Yes, you do, but let me show you why this window of opportunity is closing much faster than you think. I am not a financial advisor. This is not financial advice, and I'm not affiliated with any institution mentioned in this video. I'm merely providing educational and informational analysis based on publicly available information. Look, I have spent years analyzing historical financial collapses. What I found is this. They all follow the same formula, always 4 stages. This is what concerns me. Silver appears to be in the 4th stage right now. Let me explain what I mean. I call the first stage the establishment. Authorities build an environment that looks like stability. Prices are suppressed, the market is flooded with paper contracts, everything appears to be under control, everyone believes in the system. For silver, this process began after what happened to the Hunt brothers in 1980. Regulators were concerned about volatility, so they built a massive structure, a paper mechanism that some analysts estimate is approximately 50 times larger than the physical market. What really strikes me is this. According to published COMEX data, open interest sits at approximately 244% of vaulted silver. Think about that. With simple math, if even half of the paper holders demand actual delivery, the system could face serious stress. This is truly a situation that could cause significant problems. The second stage is about inflation or expansion. The gap between paper contracts and physical reality widens. Debt, money printing, promises stacked upon promises, but prices are still suppressed. In my view, we have been in the second stage since 2008. Reports indicate that global central banks printed over $30 trillion. The US alone reportedly added around $8 trillion to its balance sheet. But silver did not surge then. Why? My interpretation is this. Every time physical demand increased, major banks flooded the market with paper contracts, short positions, and derivatives. According to market data, prices stayed pinned below $30 for nearly 10 years. Meanwhile, something interesting happened with industrial demand. Solar panels require silver coating for conductivity. Electric vehicles require approximately 3 times more silver than traditional cars. 5th-generation infrastructure, artificial intelligence, data centers, medical devices. Industry reports now suggest that silver demand from industry is about 59% of total consumption, up from the 40% level just 10 years ago. The part that worries me most is this. Silver mine production has not kept pace with this demand. Data from mining reports show supply has declined approximately 7% since 2016. Analysts call this a structural deficit. For about 7 consecutive years, more silver has been consumed than mined. So where's the difference coming from? Above ground stocks, vaults, reserves? They are draining. India's silver imports are reported to have hit record highs. China is purchasing consistently, but paper prices remained suppressed until recently. Now, this is where it gets really interesting. According to various market reports, since around April 2011, JPMorgan has accumulated physical silver that some analysts estimate at approximately 675 million ounces. If these estimates are accurate, this could represent roughly 45% of the world's above-ground supply in 1,000-ounce bars. Let's put that into perspective. This is reportedly more than the Hunt brothers held at their peak, more than what Berkshire Hathaway ever held, more than entire nations. Why would they do this? My understanding of the events is this. In 2010, JPMorgan reportedly settled manipulation charges for around $200 million. When they acquired Bear Stearns in 2008, they inherited significant short positions. For years, they were apparently on the wrong side of the trade. So what did they do? According to market observers, they flipped. They covered their short positions, went long, massively long. Recent COMEX data shows they're now holding approximately 169 million ounces in COMEX vaults alone. This could be about 40% of total COMEX inventories. In my opinion, the gap between paper and physical has never been wider. The third stage is what I call the break. Something collapses. This never actually changes. It could be technical, it could be political. Suddenly everyone wants the real thing, the physical asset, instead of the paper promise. And there is not enough quantity available. What makes me nervous is this. I think we are watching the unfolding of the third stage right now. Let me show you exactly what I mean. November 28th, 2025. The CME Group, the exchange handling derivatives, reportedly went down due to what they described as a server cooling issue. Reports indicate the outage lasted over 10 hours. During that outage, according to trading data, silver spiked to approximately $56.72 per ounce, an all-time high at that moment. When systems came back online, market observers noted bid-ask spreads were over $1. This event looks like chaos. That is what illiquidity looks like. That is what happens when a paper market faces stress. Then, just days later, something caught my attention. According to COMEX filings, JPMorgan reclassified approximately 13.4 million ounces from registered to eligible status. Let me explain why this matters. Registered silver is available for delivery against futures contracts. Eligible silver is just stored there. It is not available for delivery. Think about the timing. JPMorgan reportedly pulled roughly 9% of deliverable silver off the table during peak physical demand. If you ask me, this tells me a lot. October 2025. Market reports showed silver lease rates hit approximately 30% annualized. This means people were apparently so desperate for physical silver that they would pay about 30% interest just to borrow it. This is not normal. That is what a forming squeeze looks like. As of today, silver is hovering around $60. Reports suggest this is approximately a 98% gain year to date, the strongest annual performance since 1980. Now, let's talk about the fourth stage. The fourth stage is what I call the eruption. Price explodes. Shorts get crushed. Institutions positioned early win big. Everyone else scrambles. This is where I believe we are right now. History is vital here. Let me tell you about Texas. 1979, two billionaire brothers, Nelson and William Hunt. They looked at silver trading around $6 per ounce and saw something others missed. Inflation, consumption exceeding production. A perfect storm. So they bought approximately 200 million ounces, about 1/3 of America's entire silver supply at the time. Then, January 1980 arrived. According to historical records, silver hit $49.45. That is roughly 800% in 18 months. Banks panicked. COMEX changed the rules overnight. They banned new long positions, forcing liquidation only. March 27th, 1980. The crash happened. William Hunt and Nelson Hunt were ruined. But here is what I think matters most. The squeeze was real, the shortage was real, and the $49 price was real. It literally took changing the rules of the entire game to stop it. Now, imagine something with me. What if the buyers were not two reckless billionaires, but the bank that helps make the rules? That might be exactly what is happening right now. 2008 taught us a similar lesson. Paper mortgage securities collapsed when everyone simultaneously wanted real assets. Historical data shows gold was trading around $720 per ounce in October 2008. By September 2011, it reportedly hit $923, an increase of approximately 167%. Why? In my view, when paper promises fail, money flows to physical reality. Gold, silver, real assets. And what concerns me about 2008 is this. Central banks did not fix the underlying problem. They just made it bigger. Reports suggest they printed approximately $16 trillion globally. They bought their own debt, suppressed interest rates to zero, and expanded paper markets even further. This brings us to today. Silver is consolidating just below $60. But let's talk about what could happen if it breaks above $60. According to reports, JPMorgan's earlier projection suggested about $38 by late 2025. We are already approximately $21 above that. Citibank analysts reportedly called for $36 to $39. Those targets have been exceeded. Some independent analysts, like Lawrence Leopard, have mentioned targets of $75 to $90 by the end of 2026. But these are conservative numbers. These assume the paper market holds together. What if it doesn't? Remember the Hunt brothers? Silver hit approximately $49 in 1980. When you adjust for inflation, that is about $170 in today's dollars. We are currently around $60. But consider this. The supply deficit looks worse now. Industrial demand is higher now, and the paper market is exponentially larger now. Historically, silver has tracked gold at a ratio of about 15 to 1. Recent market data shows it is currently closer to 72 to 1. Here is the second part of your text, translated into English with all the specified constraints. When this is corrected, and historically it always is corrected, some analysts suggest we could be looking at $280 per ounce, based purely on ratio reversion to its former level. I'm not saying that is guaranteed. We do not need conspiracy theories. We need what economists call mean reversion. And mean reversion tends to happen sooner or later. What happens when holders of paper silver contracts demand physical delivery? What happens when they realize there may not be enough metal to cover all the claims? What happens when pension funds, sovereign wealth funds, and retail investors all try to get physical silver simultaneously? That is the scenario that keeps me awake at night. December 9th and 10th, 2025, which is 3 days from now, the Federal Reserve is meeting to decide on interest rates. According to Bloomberg data, the current probability of a rate cut sits at approximately 87.2%. My thinking is this: if they cut rates, the dollar typically weakens. When the dollar weakens, historically, gold and silver tend to surge. Gold is currently trading around $4,212 per ounce. Some analysts project $4,500 to $5,000 by mid-2026. Silver typically follows gold. It always has, historically, but silver tends to move faster. It is more volatile, more explosive. In my view, the Fed meeting could be a spark. The structural deficit is the tinder. JPMorgan's positioning could be the accelerant, and a paper market under pressure could be the explosion. All the pieces appear to be in place. Physical silver is still available right now. Premiums are rising according to dealer reports. Some dealers mention delays, but you can still get it. That window might not last long. When the paper market faces pressure, when futures contracts potentially cannot be delivered, premiums could explode. We are talking about probably 30, 40, 50% over the spot price, perhaps more. Look at what happened during the 2020 COVID panic. Silver hit around $28 per ounce, but physical coins were reportedly selling for $45. That is approximately a 60% premium. Now, imagine a scenario where silver is $100 per ounce. I'm not saying this happens tomorrow, but it is probably not 10 years away either. The Fed meets in 3 days. That is the first domino. Industrial demand keeps rising. That is constant pressure. COMEX inventories reportedly keep draining. That is the countdown clock. When registered silver at COMEX drops below 50 million ounces, and it is reportedly at 113 million ounces right now, the system could face serious pressure. At current drain rates, 6 to 12 months, perhaps sooner if there is a rush. What I think people miss is this. This is not just about silver. Silver is the symptom. The dollar is the fundamental problem. Since 1971, when Nixon closed the gold window, the dollar has been pure fiat. It is backed by confidence and economic strength, but not by physical assets. And after over 50 years of money printing and over 50 years of deficit spending, some economists argue that inflation has been masked by methodological changes to CPI calculations. In my view, the bill may be coming due. Gold is at $4,200. Silver is at $59. Energy prices keep surging. Institutional money is flowing into alternatives. The entire market seems to be sending the same signal. Paper currencies face long-term pressure. Scarcity matters. In my analysis, silver might be the most undervalued scarce asset right now. Undervalued relative to gold, undervalued relative to its industrial importance, undervalued relative to money supply growth. When the market corrects that undervaluation, if it does, the move could be significant. In 1980, silver peaked around $50. It took 45 years to break that record, 45 years of what some call suppression, 45 years of accumulation, 45 years of coiling, and now we are here, $59 and climbing. The Hunt brothers were early, they were crushed, but they were right about the fundamentals. Now, imagine what would have happened if they had been patient. Imagine what would have happened if they had the backing of the entire system instead of fighting against it. That might be JPMorgan today. They learned from the Hunt brothers' mistakes. They are not going to squeeze too fast. They are not going to be reckless. They may just let the market do the work. And when silver hits $100, then $150, then $200, if it does, they will be perfectly positioned. The signals are everywhere. Record highs, structural deficits, bank accumulation, paper market pressure, Fed meetings, geopolitical tensions. It is all happening simultaneously. That is not coincidence. That is convergence. Stage 1, establishment. Complete. Stage 2, debasement. Complete. Stage 3, crisis. Happening now. Stage 4, the inevitable outcome. Loading. You do not have to believe me. I am not telling you a science fiction story. I am presenting information resulting from a proper analysis. But you should study history, and history has a way of repeating itself. I am not a financial advisor. I am just someone who has been studying these patterns, watching these markets, trying to make sense of what is happening. I can make these deductions because I am able to do this well myself. The only question is whether you are positioned to understand what is unfolding, or whether you will look back in 6 months wishing you had paid attention. The choice is yours, but think carefully. If you want to follow along as these developments happen, subscribe. I will be presenting my analyses regarding the markets here, actively and daily. Do you think silver hits $100 in 2026? Share your thoughts in the comments below. I am genuinely curious what you all think. This truly might be one of the most important financial stories of 2025.